Thank you very much, Chief, and thank you for the invitation. It's a great honor to speak here, and I would rather not speak too much, but speak a little bit, but then answer questions, should there be any. Let me first of all say that Toronto and Frankfurt have something in common, because Toronto and Frankfurt are sister cities, which I found out. And the University of Toronto and the University of Frankfurt, which is called Goethe University, they're also sister universities, so it's more than appropriate for me to be here coming from Frankfurt. Now, why is it important to share ideas and discuss them? I think we are now in the age of globalization. We are really now in a world where dialogue is essential. Countries are no longer isolated, but part of a closely interconnected community, and a globalized economy offers huge potential to all its members. Nevertheless, while we all share the benefits in good times, we also have to share the burdens in bad times, and that brings me to the global financial crisis, where I want to get to, because this crisis has highlighted how closely the world has grown together in the last years, and how quickly a problem in one corner of the world can spread around the globe, and that's why dialogue is important, especially at schools like yours and at universities. Now, this truth that dialogue is important applies all the more in countries sharing a common currency, such as the member states of the euro area. That's why I would like to suggest to take a closer look at the euro area and the challenges we are currently facing in the euro area. Back in 1999, not that long ago, 11 countries adopted the euro as their common currency. Today, the single currency is shared by 19 countries, as you all know, and it's shared by more than 300 million people, which, in my eyes, makes this a success. Having said that, though, it has not always been plain sailing in the euro area. In the wake of the global financial crisis of 2008, the euro area slid into a financial crisis of its own. This was compounded then in 2010. On the first weekend of May of 2010, I entered office on the 1st of May 2010. There's no correlation. Now, it was compounded then when Greece entered into a sovereign debt crisis, leading to other member states of the euro area suffering a sudden loss in confidence, which eventually, and I'm honest enough to say that, which eventually brought the euro area to the brink of collapse almost. Extensive rescue packages by the governments, by the finance ministers, along with what we call non-standard measures taken by the European Central Bank, then helped calm the markets and actually prevented the crisis from escalating even further. Now, while I stand here today at the end of April of 2015, some commentators may think the current situation looks similar. The ECB, the European Central Bank, has started to do extraordinary measures again with the quantitative easing program, and Greece again has taken the headlines. So you may think, have we gone in full circle back 5 years? And on 1st of May, I'm celebrating my 5th year in office. What really is the background is that Greece's new elected government objected to complying with the financial assistance agreements with the IMF programs and intended to withdraw some of the reforms that they had already adopted. You may or may not have seen that there were even brief calls for further debt relief. Now, however, after, how should I say this diplomatically, after some intense negotiations amongst finance ministers of the euro area, the Greek government settled for requesting an extension of the existing program they are under, after the Greek government had also committed to pushing ahead with economic and fiscal reforms. The finance ministers of the euro area approved a 4-month extension of the program. This was approved on February 20th, so round about 2 months ago. So we have round about 2 more months to go in order to agree on a new program between the Eurozone member states and Greece. So everything needs to have been worked out by summer. There should be no doubt in your mind that Greece certainly needs further assistance from the rest of the euro area because Greece does not have access to international capital markets. However, further assistance can only be granted if Greece continues with its efforts to restore two things: sound public finances and competitive economic structures, which we need in order to be able to lend to them. Some observers see these developments as an indication that financial integration in Europe actually has failed, given where we are right now with Greece. I have a different opinion. I see this development as an indication that financial integration in Europe has to go further. We need more integration, not less integration. Many people in Europe are suggesting we are bumping into these difficulties. Why shouldn't we have less integration? And wait, I think we have to go further. And I would like today, in my short presentation, I'd like to look at three areas where further integration could be the way forward for Europe in order to do more of integration. Now, the first area, as you will imagine, is public finances, because that's obviously also the big issue for Greece. And in order to understand the core of my argument, I'll be saying a little later, it is important to be familiar with the particular features of the European Monetary Union. TIF is, but not everybody in the room may be, so I'll just go through them real quick. The European Monetary Union is so special in that it combines two things. It combines a single monetary policy, a centralized monetary policy, with decentralized national fiscal policies at the level of the member states. That means that the monetary policy for the 19 countries of the euro area, for the 300 million people I just mentioned, is decided by the Governing Council of the European Central Bank in Frankfurt. However, the fiscal policies, that's plural, of the 19 euro area member states are a matter of the national policymakers. Each country continues to decide on its own government revenues, on its own government expenditures. So what we have an imbalance of responsibilities. And such an imbalance of responsibilities gives individual countries an incentive to borrow. This is what the economists would call a classical deficit bias. And this deficit bias is part of the particular feature of the euro system. It's sort of built into the system. And this is because the negative consequences of borrowing are spread across all member states of the monetary union. This is where the deficit bias is coming in. For example, it's spread across all member states by means of a higher interest rate level for all of them. Our objective in the euro area must be to counter that deficit bias to ensure a stable monetary union. And this can only be achieved if you realign the responsibilities in the euro area, which means a classical economic argument of liability and control having to be in balance. Now, in one way to rebalance liability control is deeper fiscal integration. A little bit like the United States of America in terms of fiscal policy. If we were to take this path, the European level would gain certain control rights over national budgets. And this is what is known as a fiscal union, which means that the 19 member states would give up sovereignty over their national budget to the European level. So you would then elevate the fiscal policies to the same level where you also have the monetary policy. You would centralize fiscal policies. So again, it would mean that, that countries of the euro area transfer national sovereignty to the European level. And that would be, this giving up sovereignty in this way would be a rather radical change. It would require wide-ranging changes to national and to European legislation. Also, the constitutional courts of the countries would have to have a say in this. And more than anything, such changes would need the support not only of policymakers, i.e. of the parliaments and the cabinets, but also of the general public. I don't think you could do such a step without calling the people to voice their opinion on such a radical change. And on this point, I would urge you to be realistic nevertheless what you would like or what you wouldn't like, I have to say that I cannot identify any willingness to give up sovereignty over fiscal policies in any euro area country, neither in Germany nor in any of the other 18 member states. If that's true, then this means that for the foreseeable future, control of fiscal policy in Europe will remain at the national level, will remain with those 19 countries. So in this area, deeper integration, as much as I would like it, still lies beyond the horizon or the realistic horizon. So at this point in time, as I say, a fiscal union remains more of a vision than of a concrete step to be taken anytime soon. However, in a second area, in another area, Europe has just taken a significant, a major step towards deeper integration, because on November 4th of last year, the European Central Bank assumed direct responsibility for supervising the largest banks in the euro area and thereby erecting the first pillar of what we call a European banking union. You are seeing I'm going from monetary union over fiscal union to banking union. Now, as of today, this encompasses 123 banking groups in the euro area, which are not a big amount, given that we have 7,000 or 8,000 banks in the euro area, but these 123 banks, they encompass more than 85% of the aggregate balance sheets of all banks in the euro area, and they are a very significant part, of course, of the risks involved in the euro area. By the way, the European Central Bank overnight basically became one of the most significant, one of the largest banking supervisors in the world. Bundesbank is one of the largest central banks in the world, but we were always small compared to others. Now, together with our colleagues from the other member states in supervision, very much like a monetary policy, we are now part of a bigger, much more prominent part of the supervisory world. Now, this banking union is certainly, just think about that, the biggest step in financial integration in the euro area since the introduction of the common currency in 1999. We haven't done any such step of financial integration since we launched the common currency. And it's not only a big step, it's to me also quite of a logical step. Single monetary policy requires integrated financial markets, and integrated financial markets include, without any doubt, also a European-level banking supervision, because that's what it should be about. So it's not only big, it's also logical. European banking supervision allows banks throughout the entire euro area to be supervised according to the same high standards. They don't have to be German standards. In addition, cross-border effects can be covered much better through joint supervisory teams consisting of members from many countries, then it can be done by national supervisors. And the third argument is the most important to me, adding a European perspective to the national views, which you still have, that does put more distance between the supervisors and the banks they supervise. It adds a level of neutrality. So out of national interest, national supervisors tend to treat their banks much more softly than they normally should be doing, and having now supervisory teams composed out of many countries gives a degree of neutrality and gives a degree of distance, which can only help this process. Meanwhile, a comprehensive banking union, which I've just am describing, has to comprise more than just an effective European banking supervision. Supervision is important. The second pillar of the banking union, and Tiff and I, we just talked about it when we met shortly, is a European resolution mechanism, a mechanism which deals with banks should they fail. And you don't want to have a same standard bank supervision across 19 countries. You want to have the same standards also should a bank fail in how to resolve those banks. This mechanism has been decided upon and will be in place by the 1st of January of 2016. The Germans, being ever so diligent, they put it into the law already since the beginning of this year, but across the euro area, it will be from the beginning of next year. So if push comes to shove and a bank is no longer viable, it will be the shareholders and the creditors who are first in line to bear the bank's losses, and taxpayers' money, which has been used all the time in the past, will only be the very last resort, which is a total change in hierarchy in the way creditors and shareholders and taxpayers are being called upon than in the past. And this will, and that's the economic argument, realign incentives, and it will make the entire banking system in the euro area more stable. My third point, the European Banking Union, as I tried to argue, is certainly a major step forward in designing a better framework for the European Monetary Union. However, we in Europe, we should also broaden our views beyond the banking sector. Banks are important, but banks are not everything. And consequently, the European Commission has proposed to establish a European Capital Markets Union. So I'm coming from monetary union over fiscal union over banking union to what we now think is a Capital Markets Union. Now, this will be the third major step of financial integration in Europe, although this still lies in the future. In essence, the European Capital Markets Union has two objectives. The first objective is to increase the share of capital markets in the funding mix of the real economy of the 19 member states. And the second objective is to integrate capital markets more closely across borders. Now, some people relate the first objective, the funding mix, to the question, and very much the Germans are asking me the question, whether a capital market-based financial system, like you have in Canada, or like the one in the UK or in the US, so whether a capital markets-based financial system is superior to a bank-based or lending-based financial system as we have in continental Europe. Well, to sum up the empirical evidence, it depends. It's not that easy to say. It depends on a number of factors and on a number of country-specific characteristics, which actually makes it hard to provide a general answer. Nevertheless, the recent crisis we are coming out of shed light on these issues from a very different angle, a system in which the real economy relies only on a single source of funding, in the case of continental Europe only on the credit markets, will most certainly run into trouble when this very source dries up, regardless of whether it's a, by the way, lending-based or capital market-based type of funding. So, therefore, it is not really a question of either or, of capital markets versus lending-based. The objective of the European Capital Markets Union, which we're about to embark on, is not to abandon bank-based funding, not to get rid of bank-based funding, but to supplement it with capital markets-based funding, to go from one source of funding to two sources of funding. And I have to tell you, in Europe, above all places, there is ample room to complement with capital market-based funding. The European stock market is only 60%, all of the 28 member states now. The European stock market is only 60% the size of the US stock market, when you measure it in terms of, in relation to GDP, and likewise the European market for venture capital is 20% of the size of the US market, and for securitization it is even lower than that. On the other hand, it is my understanding that Europe has 50% of all bank credit globally, although its GDP is roughly the size of the US, which would be 1/3 of the global. So we have a much higher share in the credit markets than we have in GDP. In the end, I would argue it comes down to the uncontested argument of diversification. Increasing the share of capital markets, I'm quite certain, will improve and broaden access to funding, and particularly to the SMEs, so the small and medium enterprises, which form the backbone of many European economies, very much forming the backbone of the German economy, as you know. At the same time, it will improve the matching of investors to financial risk, thereby increasing the efficiency of the financial system. As a result, the financial system will be able to better support sustainable economic growth. So far about the first objective. The second objective of the European Capital Markets Union is to improve the integration of capital markets in the entire European Union. One of the main arguments is that integrating capital markets can improve private risk sharing. Now, the technical question I would like to ask is, and also like to answer is, to what degree does a shock to the economy affect consumption? Now, empirical studies for the United States, for the deepest market, show that integrated capital markets cushion around 40% of the cyclical fluctuations amongst the federal states of the United States. Amongst the 50 states, a share of around 25% is smoothed via the credit markets, while fiscal policy cushions 10 to 20% of shocks. Altogether, around 80% of a given economic shock is absorbed before it can affect consumption. Actually, studies for Canada yield very similar results, although your capital market is not as deep as the one of the United States. Now, in Europe, the picture looks very different to over here in Northern America. Here it is, in Europe, it is mainly credit markets that cushion economic shocks, given the reliance on this side of the equation. And they are actually, those credit markets are not very effective in doing so. Altogether, only around 40% of a given shock is absorbed before it can affect consumption, relative to the 80% we've just been discussing in the United States or in Canada. Now, increasing the share of capital markets and integrating them across borders in the European Union would therefore help improve risk sharing in Europe and would reduce the volatility of consumption. Now, to be sure, the argument for capital markets union is straightforward, but the implementation is not at all straightforward. It is much less straightforward. The capital markets union is very complex, is a hugely complex undertaking affecting many, many different areas. Look only at the different instruments you have. You can go from bonds to equities. You can have peer-to-peer lending. You have so many different instruments which all fall under the capital markets function. Consequently, the European Commission has presented a wide range of suggestions and a wide range of steps to be taken. There's a green book out, which was published maybe 2 months ago. I firmly believe, I should say, that Europe should embark on the path towards a capital markets union in order to enhance the stability and prosperity of the European economy. Let me come to the close, quoting George Washington, who is credited with having written, by the way, more than 2 centuries ago, in a letter to a friend, that he would think a United States of Europe would come into being. And by the way, it was not only George Washington who said that after World War II. I remember Winston Churchill in a very famous speech also, by the way, thinking about the United States of Europe coming into place, but he thought at the time that Great Britain would not be part of this. But again, this idea of a United States of Europe has been around since a long time. And that such an idea is certainly a very bold vision, because it goes beyond a fiscal union. It is aiming at an encompassing political integration, even beyond fiscal union and fiscal integration. In my short speech today here in Toronto, I'm much more modest, just concentrating on the economic aspects of integration in Europe. Let me remind you, I've tried to highlight in 3 areas where deeper integration might help enhance the stability of monetary union. The first area is public finances. Although a European fiscal union, as I argued, is currently a rather unrealistic vision. The second area is the banking system, an important part of the financial architecture. And here we have taken just a major step forward by starting the banking union on November 4th of last year. Again, the most important step of financial integration since the introduction of the common currency, since the introduction of the euro. And the third area, as I argued, could well be capital markets. Now, looking to the future, I consider a capital markets union another project of fiscal and financial integration that could contribute to enhancing the stability of the European economy. To be sure, these are all very, very big steps, especially the ones which go into the future, the capital markets, but in our view at the Bundesbank, they are worth taking, A stable monetary union in the euro area will eventually benefit all member states in the euro area and also the rest of the world, which of course includes Canada. Let me stop here, and I'm more than happy to take questions should there be any. Thank you very much.